Halo, Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Faniya, class accounting D. NIM 2210426899. Here I will read the chapter for material. Financial statement. Learning outcome. After studying this chapter, students are expected to be able to 1. Explain the meaning of financial statement. 2. Differentiate and classify the types of assets and liabilities. 3. Explain the forms of financial statement. 4. Understand the basis and purpose of financial statement. 5. Develop financial report format. The definition of financial statement. Figure 3.1 example of financial statement. The figure 3.1 above depicts the financial statement of the college shop. Financial statements are a collection of summary level reports about an organization's financial results, financial position, and cash flows. They are useful for the following reasons. 1. To determine the ability of a business to generate cash and the source and use of that cash. 2. To determine whether a business has the capability to pay back its debts. 3. To track financial results on a trend line to spot any looming profitability issues. 4. To derive financial ratio from the statement that can indicate the condition of the business. 5. To investigate the details of certain business transactions as outlined in the disclosures that accompany the statement. The standard contents of a set of financial statements are: balance sheet, showing the entity asset, liabilities, and stockholders' equity as of the report date. It does not show information that covers a span of time. Figure 3.2 balance sheet. Income statement, showing the results of the entity operations and financial activities for the reporting period. It includes revenues, expenses, gains, and losses. Statement of cash flows, showing change in the entity's cash flows during the reporting period. Supplementary notes, including explanation of various activities, additional detail on some accounts, and other items as mandated by the applicable accounting framework such as GAAP or IFRS. If a business plans to issue financial statement to outside users, such as investors or lenders, the financial statement should be formatted in accordance with one of the major accounting frameworks. These frameworks allow for some leeway in how financial statement can be structured. So statements issued by different firms, even in the same industry, are likely to have somewhat different appearances. Financial statements that are being issued to outside parties might be audited to verify their accuracy and fairness of presentation. If financial statements are issued strictly for internal use, There are no guidelines other than common usage for how the statements are to be presented. At the most minimal level, a business is expected to issue an income statement and balance sheet to document its monthly results and ending financial condition. The full set of financial statement is expected when a business is reporting the results for a full fiscal year, or when a public health business is reporting the results of its fiscal quarters. Classification of asset, debt, and capital. The composition of assets and liabilities in the balance sheet is as follows. Assets, current assets, long-term investment or investment, tangible fixed asset or fixed asset, intangible assets or intangible assets, other assets, liability, owner's equity, liabilities, current liabilities, unearned income, long-term debts or long-term debt, other debts or other liabilities, owner's equity or capital, paid in capital or capital stock, agio or disagio shares or agio or disagio capital stock. Receivers, retained earnings. Assets are future economic benefits that are expected to be received by a business entity as a result of past transactions. Assets have three main properties. Figure 3.5 asset. 1. Having the possibility of future benefits in the form of the ability, or either alone or in combination with other assets, to contribute to cash inflows in the future either directly or indirectly. 2. A certain business entity can obtain benefits and monitor these benefits. 3. Transactions that cause the company's right to obtain and supervise the benefits have occurred. Current assets. Current assets are cash and other assets or sorts that are expected to be realized into cash or sold or consumed during the normal business cycle of the company or within 1 year. Look at the figure 3.6 below. The elements included in the category of current assets are: 1. Cash is available for business now and elements that can be likened to cash. For example, checks, money orders, and others. 2. Inventory of merchandise, raw materials, work in process, finished goods, auxiliary materials and spare parts used in the maintenance of tools and machinery. 3. Trade receivables and notes receivable. 4. Receivables from employees, subsidiaries, and other parties if received within 1 year. 5. Installment receivables and installment notes receivable if they are common in trade and will be repaid within 1 year. 6. Marketable securities, which are short-term investment. 7. Costs paid in advance, such as insurance, rental interest, taxes, party material, and others. Long-term investment. Non-current assets, which include several types of investments that can take the form of securities, provision for funds, and other long-term investment. Figure 3.7 Long-term investment. The elements that are included in the long-term investment group are: 1. Long-term investment in securities such as stocks, bonds, and long-term notes. 2. Investment in subsidiaries including long-term and venture. 3. Investment in tangible fixed assets are such as land, machinery, but not yet used for business now. For provision of funds for long-term purposes such as funds to pay off bonds, expansion funds, own stock purchase funds, pensions payment funds, funds building replacement, and others. 5. Cash surrender value for life insurance policies. Tangible asset, also known as hard asset, are physical items with a clear purchase value used by a business to produce goods and services. Examples of tangible assets include PP&E, furniture, computers, and machinery. Business can also have non-physical assets known as intangible assets such as goodwill, patents, and copyrights. Current vs. fixed asset. Tangible asset can be divided into two groups: fixed and current. Current assets, also known as liquid assets, are either cash or items which a business expects to sell by the end of the financial year. Current assets can be sold to increase cash flow or ease debt and other liabilities. Stock is an example of a current asset, as it is expected to be sold in the near future. Fixed assets are physical items that cannot easily be sold at any point usually, because these items are considered long-term investments or because they are essential for the day-to-day running of the business. Machinery and property are examples of fixed assets, as both are essential in the running of the business, so cannot easily be sold. Tangible assets in accounting. Tangible assets are entirely recorded on a balance sheet at the price the original cost. However, they will eventually move onto an income statement through one of two ways. Current assets should be organized on the balance sheet depending on how easily they can be converted in cash, with the most liquid asset coming highest up the document. When current assets are used, they become part of the cost of goods sold. Fixed assets move to the income statement through depreciation, an ongoing process whereby the cost of an asset is recorded as an expense over its usable lifespan. For example, a computer lasts several years before it breaks or becomes outdated. The initial cost is spread out across the predicted usable life on the computer, with some of the costs being recorded as an expense every year. Tangible asset in debitor. Debitor invoicing software helps you keep track of company assets and monitor their value of time. With debitors regular price plans, you can enter an asset then track the depreciation over the asset's usable lifespan. Just enter the asset as an expense, mark it as an asset the turn of the depreciation. The debitor use strike line depreciation to break down the cost of the asset of a set number of years to make it easier to monitor the value of your asset. Figure 3.8 Depreciation Profile for Computer. Intangible fixed asset. Intangible assets include operational assets that lack physical substance. For example, goodwill is a fixed asset, as are patents, copyrights, trademarks, and phrases. A company's intangible assets are often not reported on a company's financial statement, or they might be reported as significantly less than their actual value. This is because assets are accounted for at their historical cost. Unlike tangible fixed assets such as a building or machinery, intangibles are often developed internally without any direct measurable cost that can be capitalized. When an intangible is purchased, however, or when costs can be directly traced to the development of the assets, the cost is recorded as an intangible asset on the balance sheet. Intangible asset valuation. Intangible assets are valued and their cost of acquisition. A purchased intangible is valued based on the amount paid for the asset. Research and development costs associated with developing an intangible are expensed for the year in which they were incurred. However, costs of registering patents or trademarks and legal fees incurred to defend a company's right of use are included in the cost of acquisition, which is reported as an intangible asset of the balance sheet. Intangibles with a determinable life. Intangible assets with a determinable life are amortized over their useful lives. Amortization is a process of allocating the expense over several accounting periods to reflect the actual amount of the asset consumed each period. The useful life of an intangible asset is usually assumed to be the intangible asset's legal life, although the useful life will often be shorter. A patent, for example, has a legal life of 2 years, but its useful life might expire earlier than this if a new invention makes the patented technology obsolete. Intangibles with an indefinite life. Many intangible assets have indeterminable lives. For instance, there is often no reasonable way to determine how long a company brand will hold value. For this reason, intangibles with an indefinite life are not amortized, but are tested for impairment instead. An impairment expense is recognized in the assets carrying value exceed its fair value. A company sold the test all intangibles for impairment at least once each year. Once the impairment is recognized, it is now permitted to be recovered. ERS rules on intangible assets. Section 197 of the Internal Revenue Code defines tax accounting procedures for intangible assets such as copyrights, goodwill, and trademarks. These assets must be amortized over a period of 15 years regardless of their useful life. Section 197 does not permit impairment testing, but it might allow you to recognize a loss if the asset is disposed of before it is completely amortized. If you are buying a business or a stake in a business, which includes intangible assets as part of the selling price. The intangible can amortized by the buyer only if it was amortized by the seller, and only if the transaction was not part of a series of related transactions. This is known as the anti-carning rule, designed to ensure an owner doesn't convert intangibles that don't qualify for amortization into tools that do. Other assets or assets. These are assets that cannot be included in other groups such as deposit to sellers, to guarantee contracts, buildings in progress, long-term receivables, and fines to company officials and ATC. Liability and owner's equity. Liabilities are defined as a company's legal financial debts or obligations that arise during the course of business operations. They can be limited or unlimited liability. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or service. The owner's equity is simply the owner's share of the assets of business. You see, as such, can only belong to two types of people. People outside the business who you owe money to, debts known in accounting as liabilities, the owner himself, owner's equity. Current liabilities. A current liability is an obligation that will be due within 1 year of the date of the company's balance sheet, and will require the use of a current asset or will create another current liability. However, if a company's normal operating cycle is longer than 1 year, current liabilities are the obligation that will be due within the operating cycle. Current liabilities are usually reported as a spare section of a company's balance sheet. This allows readers to subtract their total from the company's total amount of current assets in order to determine a company's working capital, dividing current assets by the current liabilities in the company's current ratio. Examples of current liabilities. The following are common examples of current liabilities: accounts payable or trade payables, notes payable that will be due within 1 year. The principal portion of a long-term loan that must be paid within 1 year. Wages payable, income taxes payable, interest payable, other accrued expense payable, different revenues, and customer deposit. Revenue received in advance. Under the accrual basis of accounting, revenues received in advance of being earned are reported as a liability. As the amount received in advance is earned, the liability account shall be debited for the amount earned, and a revenue account shall be credited when a company receives money in advance of earning it. The accounting entry is a debit to the asset cash for the amount received, and a credit to the liability account such as customer advance or unearned revenues. As the amount received in advance is earned, the liability account shall be debited for the amount earned, and a revenue account shall be credited. This is done through an adjusting entry. Examples of revenue received in advance. The following are a few examples of revenue received in advance. An insurance company receiving premiums for protection during the following 6 months. A magazine publisher receiving money from a subscriber for magazines for the following year. A website design company receiving a client's down payment for future work. Law firm receiving a retainer fee from a new client. Long-term liability. A long-term liability is an obligation resulting from a previous event that is not due within 1 year of the date of the balance sheet, or not due within the company's operating cycle if it is longer than 1 year. Long-term liabilities are also known as non-current liabilities. Examples of long-term liabilities. Some examples of long-term liabilities are the non-current portions of the following: bonds payable, long-term loans, pensions liabilities, post-retirement, health care liabilities, different compensation, different revenues, deferred income taxes, customer deposit. Some long-term debt that we bill due within 1 year of the balance sheet that can continue to be reported as a long-term liability if there is a long-term investment that is sufficient and restricted for the payment of the debt, or intent and a non-cancelable arrangement that assures that the long-term debt will be replaced with new long-term debt or with capital stock. Other liabilities. Debts that cannot be reported in the title above are reported under other titles. For example, debt bonds that are due but will be repaid from the bonds settlement fund. Long-term debt to company official or to subsidiaries and others. Debt that may arise due to past activities are called contingent liabilities. Such debts are shown in the balance sheet with footnotes that include unconfirmed debts, for example, discounted not payable, legal disputes, taxes, and other expenses which is uncertain, and the guarantees given. Okay, thank you. Wassalamualaikum warahmatullahi wabarakatuh.